Financial markets have taken off overnight as the majority of the US Federal Reserve members signalled an easing in supercharged interest rate rises to beat down inflation. The markets are just opening here in Australia now, and our business editor Ross Greenwood joins us. Ross, how will the markets react? It's probably a little too early to tell 2 minutes into trading.
Oh, well, yeah, it probably is. But generally, this should be pretty positive news for markets, there's no doubt. And the US market overnight did turn around on the news that the majority of members of the US Federal Reserve believe that they think that interest rate rises that have been at supercharged levels in the United States should start to ease off. And the reason for that is largely because they're seeing a slowing in inflation, though not getting back to the levels that they would like it to be. So if we go, say, for example, to our market, really on the first couple of minutes of trading right now, you can see that the benchmark index has opened up around 13 points, and that's probably a little less than what the US markets were. We'll just wait for the next few minutes and see what comes out. The other barometer here is going to be the Australian dollar. Now, the Australian dollar right now, as we speak, is sitting at 67.34 US cents, so you can see that that has jumped overnight. US dollar is weaker. The reason for that is if the United States, suddenly the return on its interest rates are considered less than previously anticipated, there's less attraction for the US dollar, there's more attraction for currencies such as the Australian dollar. But analysts right now are trying to work out exactly what this fight on inflation means. Let's go to one of those analysts who commented on this from overnight.
The Fed's thinking is that, listen, we want to avoid a recession, but we know that we have to combat inflation, right? So we're going to have more rate hikes, but less aggressive than what we've seen in the past. So that was a very favorable Fed minutes for the market, and that's why you see it up after the minutes were released.
What's going on in the travel industry is pretty interesting at the moment. Qantas yesterday signalled that travel, especially domestic travel, is absolutely booming. We could see that in the profit that's been driven out of Qantas. And this is despite, we all know, huge prices for tickets that we haven't seen in quite some time. So what does that say about the fight against inflation, Ross?
It's almost in many ways the litmus test for this fight against inflation that the central banks are trying to go for. Right now, if you thought the interest rates were having an impact, you would see declining travel. You would see people not wanting to travel. But what Qantas reported yesterday was an upgrade in its profits in just the last 7 weeks of $150 million for this next financial year. So already that had been upgraded. So it's expected now to be around $1.5 billion. And as you say, close to record travelling for Qantas. Domestic travel is back beyond 100% right now. You can see here what Qantas shares have done over the past year, but even in the last little while, getting back to record levels around $6.18. And what Qantas says is that people are prioritising travel over other forms of spending, which is one aspect of this. But the question is whether eventually, when these interest rate rises keep on going, because do bear in mind, the price of travel is more expensive. That's inflation. The people are absorbing that. But there comes a point when the rate rises go so high, people can't absorb that, and that, as many people are expecting, is going to come in the middle of next year.
OK, the last two interviews you did with Alan Joyce, in the first one, he promised no return to 1960s style ticket pricing, and the second one, he said that there is no way that Qantas could absorb the rising cost in jet fuel. Don't the last couple of days and that profit results show that those two things aren't true?
Well, yeah, and the interesting part about this is partly about capacity and demand. What Qantas has done deliberately is taken aircraft out of the sky to be able to cope with what they anticipated to be outbreaks of COVID and therefore staff outages. They didn't want to have the lack of reliability that they were suffering earlier in the year. So they took those aircraft out of the sky. But by taking capacity out of the sky when demand is so strong, you know what happens to ticket prices. They only go one way, and that is up. The same is happening also for international travel, and in many ways because there's a lack of Chinese flights coming into Australia right now, there is also quite clearly a lack of capacity, and that again has driven up international travel prices. And to make things kind of interesting, remember that the price of oil has come down from when it was around $120 a barrel, now sitting in the mid-80s, for example. So that means there's less pressure on the price of jet fuel than what there was when those warnings initially came out. But regardless of that, the people are paying the prices because they want to travel right now.
OK, talk to me about New Zealand. What's going on there? The US Federal Reserve seems to be pulling back, but we see in New Zealand their Reserve Bank is going as hard as they've ever gone before and a warning of a shallow recession for 4 quarters next year. What does that mean for us?
Well, you know how sometimes we've explained about the narrow path that central banks say that their economies are on. US Federal Reserve has said it, the UK has said it, and here in Australia, the Reserve Bank has said it as well. Well, certainly in New Zealand, they've said they've fallen off the path. In the UK, they've fallen off the path. The recession is really the answer if you get these things wrong. In other words, if you keep pushing these interest rates up so aggressively, you deliberately push your economy into a recession. So this is the comparison between New Zealand and Australia. In Australia, our cash rate right now, 2.85%. The Reserve Bank has eased off on 0.5% rate rises. It's come back to 0.25% rate rises. In New Zealand, they've gone hard. Again yesterday, 0.75%, takes its cash rate to 4.25%. But look at the inflation rate there. Australia's inflation rate now is only marginally higher than what New Zealand's is. But in New Zealand, they've decided to try and crush it, to beat that down. Here, we're trying to somehow manage a soft landing, and only time will tell as to which approach is right, because what you really would not like to see is for a very long time you have higher interest rates than you need to because you did not crush the inflation when you had the opportunity to do so.
Looks like we live in a luckier country from that chart there. Ross, good to talk to you as always. I'll see you soon.